Start off, ladies and gentlemen, we're going to begin with our first panel discussion of the morning, and we shall hear our esteemed panelists share their insights on institutional investors, priorities, trends, and allocation preferences. Let's begin by welcoming our moderator for the session, Mr. Bhavin Shah, private equity leader, deals leader, and PwC India. Bhavin brings with him over 25 years of experience to his role spearheading the deals team within PwC India. Leading a dynamic PE team of over 1,000 professionals, he orchestrates a comprehensive range of services spanning fundraising and financial due diligence to valuations, investor relation management, post-deal advisory to strategic deals. Ladies and gentlemen, please put your hands together and make some noise for Bhavin Shah. Welcome, Mr. Shah. Let's welcome our next panelist, Anand Unikrishnan, Managing Partner, NIIF Fund of Funds. Anand has over 2 decades of experience across India and Australia in areas such as investment management, finance, and consulting, of which over 12 years have been in investment management in India. Throughout his career, Anand has been involved in several direct and fund investments in sectors such as roads, power, healthcare, renewable energy, and real estate. At NIIF, he is responsible for developing and executing the strategy of the NIIF Fund of Funds, which is diversified fund investing into various sectors and strategies through third-party fund managers. Let's put our hands together and welcome Anand Unikrishnan. Our next panelist is Manish Kejriwal, founder and managing partner, Kedara Capital. He brings with him over 15 years of experience encompassing the full circle of experiences in private equity across a variety of industries and sectors in private and public companies, and in other fund private equities. Prior to co-founding Kedara, Manish founded the India office of Temasek, where he headed all its investments and other activities. Previously, he was partner at McKinsey & Company, where he helped found the private equity practice. Ladies and gentlemen, let's put our hands together for Manish Kejriwal. Our next panelist is Mitesh Daga, partner, TPG Capital. Mitesh Daga is based in India and a partner with TPG Capital, the leading US-headquartered global alternative asset manager. He brings more than 20 years of investing, financial, and entrepreneurial operating experience from leading global institutions. And prior to joining TPG in 2014, he worked with Advent International in the UK and in India, and with Capital One in the US. Ladies and gentlemen, let's make some noise, please, for Mitesh Daga. Our next panelist is Roshni Bakshi, Managing Director, Private Equity, Everstone Capital Asia Private Limited. Based out of Singapore, Roshni's role includes driving value creation in investing companies across all verticals in the areas of high performance teams and human capital management, brand transformation, and ESG, including impact. Prior to Everstone, she was the CEO and Managing Director for the Walt Disney Company's consumer, media, and retail business for South Asia, where she set up and grew the business to more than $400 million in revenue. Let's put our hands together and welcome to the stage, Roshni Bakshi. Keep that applause going as I welcome our next panelist, Wendy Werner, Country Manager, IFC India. Wendy implements growth and diversification of IFC India's portfolio with a particular focus on maximizing IFC's development impact. India is IFC's largest client country with approximately $3 billion committed in FY23. Prior to her current role, Wendy was the IFC Country Manager for Bangladesh, Bhutan, and Nepal. She has implemented IFC's strategy to expand financial inclusion, sustainable infrastructure, and support competitiveness through investment and advisory services. Ladies and gentlemen, let's welcome Wendy Werner to the stage. Mr. Shah, I'll hand the stage over to you.
So we have with us today a mix of LPs and GPs. We have a global LP, Wendy. We have a Indian LP, Anand. We have Asian GP, which is Everstone. We have Indian GP, Manish, and we have global GP, which is TPG and Mitesh. So with this panel, I hope to have all the answers that we would have questions around. We're going to talk about many trends that are shaping the private equity world. We've been hearing, so I was in Hong Kong just yesterday with a bunch of sovereign wealth funds, and everybody's talking about India. We've been hearing about India's decade for last several months, and each of you have really gone to the global LPs and checked as to what do they think about it. So I'll start with Manish. You, what has been your take on the sentiment of India when you go and raise the recent fund that you're currently raising?
Thanks, Bhavin. And Nupur, thanks for having us all here. Pleasure being here. It's probably the most diverse group of people that I've seen in a conference, and really good to see everyone in the room. To your question, as you know, Bhavin, many of us voted with our feet and got back to the country many years before India was really cool, right? Late 90s, mid 90s.
Right.
And we've made a career of being in India. So it feels like everything is finally clicking together for the country, whether you look at the macro, you look at levels of governance, the quality of the entrepreneurs has always been the reason why we, as Kedara or as Temasek before that, had invested in India. And the quality of the entrepreneurs is never, but the levels of governance are much better. I think you attach all that with the current government we have in power, almost no confusion on which way the vote will go. So at least the consistency in policies, though other people with my last name may not like him, as what you saw in the papers this morning. But jokes aside, there is, for the first time, a lot of macro stability. We used to always talk about the twin deficits in the past. I haven't heard that word in the recent, even though it is an issue. The rupee, which is always a challenge, has been stable and actually been slightly appreciating. So nothing could look better. But this time, actually, the reason I believe everything is not as good as it can be is, and I'd love to hear Anand and Wendy's perspectives on this. There's often, if you look at 2023, the facts will say a significant fall in DPI and exits, a significant fall in deal volume, an even larger fall in new funds raised. Whether I'm talking about globally, but that same facts, if you look at the Bain report, applies to India also and in Asia more generally. So it seems like confusion when the macro has never been better, level of governance has never been better. Why is this disjointedness? And I really believe some of the issues now stem from the global flows. When we have interest rates the way they are, the rate of returns, the fabulous 7 returning what they are in the US, why should you be doing private equity in a remote place like India? So the question which comes back is from a risk-reward perspective, does it make sense to be in India? One.
Right.
And question number 2, I would say is there is a denominator issue and a numerator issue in many of the global LPs, whether they be pension funds, whether it be endowments. And if they haven't seen a significant amount of realizations and cash flows back to them, if you look at what's happening to their public positions, which have contracted with the public markets, many of them don't have the capital available to deploy in private equity. I would say, and I'm happy to chat about it a bit later if that's helpful, where I predict India is going to go towards is more a barbell. And I think there'll be some GPs which will wallop up most of the cash.
Yes.
And I think there will be others which will really struggle to raise funding in 24 and 25. So I think the theme of consolidation is playing out globally. I don't think India is different. And I think given the challenges we have in terms of liquidity for the industry globally, I think anyone raising funds in 23 probably deferred it a little now. And people who are trying to raise funds now are hoping they'll do it at the end of the year or next year, because the amount of liquidity to put into private equity, I don't think has been lower in the last 4 or 5 years.
No, it definitely is lower, but with China, at the stage where it is, the Asia funds, and I'll just maybe move to Mitesh, the Asia funds allocation, how do you see that allocation now spread across the Asian regions? And do you think India will benefit? Means, of course, the fundraise in global and Asia has been lower, but the global fundraise where Asia allocation, and within Asia allocation, how much would probably India be? And in Asia funds, again, what is your thought on how would India allocation be?
Sure. Firstly, thank you, Nupur and Bhavin, for having me over here. Just a small anecdote this morning as I was dropping my 8-year-old daughter to school. She asked me on the way on how does your day look like, and I told her it's starting with a bang with this conference that I'm going to for promoting diversity within our industry. And I asked her if she had any advice for me as I speak at the panel. So she's just very recently got in love with jalebis. And the one advice she gave me was that when you're speaking, just be sure that your speech is more interesting and your audience is more interested in your speech than eating jalebi outside. So I must say I was very relieved to see that there were no jalebis outside, and hence we have all of you in the room. So thank you for joining us. Manish was very modest with his answer on India. I think all he could have said is that, guys, just check the audience that I had at my AGM a few weeks back, which was a massive crowd puller. And I think on basis of that, Manish will probably be selling tickets to his AGM next year. But India clearly is a bright spot in the world right now. We will be contributing a large share of to the world GDP over the next decade at least, if not for many more following that. That can be anywhere from 20 to 25% of world GDP. We are at an inflection point. We have, McKinsey has had coined us, had it in their famous report on India many, many years ago. I think they were ahead of their time. But India's time seems like has finally come, and it's now seen in numbers. We are, from a GDP per capita perspective, touching that $8,000 mark on a PPP basis, which is where US was in the 70s, China was in the 2007, 2008. And that's typically a tip-off point for an economy based on what we have seen across the world, where you see an inflection in consumption moving from your basic spend to the more discretionary spend. So we expect at least about $2 trillion of consumption spend incremental to come in India over the next decade, and that is a massive opportunity, which is not lost on the LPs globally. So coming to your question, Bhavin, India clearly is seeing a lot of attention because of that. We will for sure see more allocation globally into India and also from the Asia funds. China has taken a little bit of backseat for various issues that all of us have seen and are aware of. And that allocation is now moving. The two hot geographies that LPs are talking about in Asia are Japan and India right now, which can provide both scale and growth. So Japan has a lot of these large billion-dollar ticket size opportunities. Very difficult market to operate in. You have to build a local team. You have to build a very senior team. It's a market which operates on relationships. India, again, not an easy market, but PE firms have been here for a long time, and now is a time when you will see a lot of growth happening, such as what we are seeing with Kedara. So these are the two big economies and a lot of excitement, and we'll see a lot more assets getting allocated here.
Okay. Moving to Wendy, do you see the same type of allocation within IFC? Means is Asia and India going to get more allocation of the investments that IFC makes?
Okay, great. Well, thank you. Thank you, everyone, for having me. So just to also put myself in context for this panel. So IFC, of course, is a major LP investor, but we also have many other products. So we have the choice to be looking at debt, structured guarantees, as well as funds and private equity directs as well. So broadly speaking, I think in the global view, I would definitely agree with my other panelists with regard to India being a bright spot on the macro side. IFC has had now quite a good experience over more than a decade of quite large portfolio here in India on the PE side, at least by our standards. So our private equity direct and funds is for India. India is the largest allocation or the largest portfolio for IFC globally, and the funds portfolio and the equity portfolio is twice as big in India as any other country globally. Now, we don't work like on a kind of an allocation basis. Like there's not like at the beginning of the year, this is how much is going here and there. It really depends on what we see, and we are focused very much on looking at track records. So I think the points that were already raised around exit scenarios being stronger now, funds that are looking at value creation, but also at the key themes that are important for the economy. This is where we drive our investments. So we do have kind of a strategic focus, which includes quite critical items like climate change and transition, infrastructure development, also inclusion and gender inclusion as well. So this is kind of the overlays that we look at, but I think the trends are very strong for India. I think the fundamentals are very strong, and that's where we do see a very positive inclination to looking at continuing to at least increase the allocation to India. But it really depends on what the strength of the offers on the table. Thanks.
Thank you, Andy. Anand, what about Indian LPs? Like, do you see institutional capital coming through? And I have a question on retail as well. And Manish, I don't know whether you've really gone retail, but what about the India family offices? But maybe start with you, Anand. How do you see fundraise happening at your end, and Indian institutions, are they likely to come through with the big checks?
So thanks, Bhavin, and it's great to be here. So thank you, all of you. Look, just to describe who we are. So we are an Indian LP for Indian GPs, and we are also an Indian GP for global LPs, right? So that's who we really are. So I'll answer your question in two different parts, right? So for the Indian GP, is domestic capital becoming important? Absolutely. And that domestic capital is, I mean, we are a source of that capital. You have some government pools of capital, which is going into funds, backing new managers and new strategies and things like that. And then there is the whole HNI community and the HNI private wealth going into the Indian ecosystem, as well as insurance companies that are actually now started to write bigger and bigger checks. Still small relative to what their balance sheet sizes are, but I think they're still becoming meaningful for Indian GPs. Just on the domestic component, look, my hope is that at some point you would have somebody like an EPFO, somebody like an NPS, and just to put things in context, right? The Indian pension system today is about $600 to $700 billion. And in about 5 to 7 years' time, we'd be almost double that size. So about $1.5 trillion or thereabouts from the Indian pension pool. Now, is that pension pool going into private equity and VC? Zero. There's no allocation at all. I hope that changes over time, and I hope that if that changes, just think about where EPFO was sitting in 2015 with public equities. With public equities, EPFO had zero allocation in 2015. Today, 15% of the allocation goes into public equities. And look at what's happening to our capital markets, and we talk about domestic flow supporting the Indian markets and all of those themes, right? So I think there is a lot of institutional capital that still does not access Indian private equity. And the way I think about it is if a Canadian taxi driver is benefiting from Indian growth, why should an Indian taxi driver or an Indian worker not benefit from Indian growth, right? And that should happen. So hopefully that will happen over time. But look, just on the international side, I'll just make a couple of comments, in addition to what my other panelists have said. I think from an opportunity point of view, the world is sort of now realizing that India over the next decade, or in some cases, you hear the century, right? India is an opportunity for global LPs. When they look at their portfolio, what do they see? They see that they have always under-allocated to India. So relative to the size of our economy and our contribution to global growth over the next decade, 2 decades, global LPs are actually extremely under-allocated and have fractional exposures to India. And that is where you're seeing a lot of the interest. Do I think that a lot of that interest is going to quickly convert to cash coming in? No. I think fundraising for India, for Indian GPs, is usually hard or harder. I mean, there are exceptions, of course, and Manish is doing a fantastic job in building his franchise, and there are a couple of others. But I think the reality is investors are still going to remain very, very discerning when it comes to track record, when it comes to realizations and DPIs. And unless a manager can deliver that, I think the Indian GP community is still going to struggle to raise money. Right? So without dilution, I think the responsibility on the GPs, including us, right, is don't dilute your standards. The best time to raise money is usually a really hard time to deploy. So you want to be careful about, where you're deploying. You want to be careful about the discipline of the balance between the MOIC, the DPI, the IRRs, and all of that coming together. And if you can do that on a consistent basis, I think you will get noticed by global LPs, and the money will come. So it's still a long-term game, not easy. I think today is hard, not harder, which is a good thing.
Very interesting.
So just to close off on the domestic, the retail side. Firstly, I just want to agree with Anand. I think the biggest opportunity in terms of stock of potential LP money is the pension funds, the government pension plans. I think, Anand, to give credit to the government, it's basically been a regulatory issue, but it hasn't come in. And to be fair to at least one of them, which is IRDA, has started allowing, I would say, still too little, but a significant amount of money is flowing in from the insurance companies. And I think as an LP, if I was to just change the lens a little bit, I would say if we were ever to raise domestic capital, I would do it from places like an insurance company, whether it's an LIC or this plethora of domestic private sector insurance, because there's a duration matching. People understand the product. Globally, it was the insurance companies which actually led the way to the birth of a KKR or a Blackstone, if we go back in time, right? So the critical part there is to understand the concept of duration matching, that you invest money, you're locked in for 10 years, and I don't think the retail population understands that. So my biggest worry on the money going retail is actually a mis-selling of the product. But let me also say that the amount of money being raised by the retail is incredible. But that's if you look at if you remove the first layer and analyze why, it's the economics of the distribution chain. And now I'm exaggerating to make the point, is often better than that of a manufacturer. Yes. So I have not often on a panel in this hotel joked with Karan next to me saying, I would want to give up and hang my boots as a manufacturer and become a distributor because the economics are a lot better. And just to close the loop, what we have done as Kedara, Fund 1, we actually had domestic investors. We had 6 or 7 very high quality family offices, amongst the largest in the country, where we overemphasized the risk and the lack of liquidity. You've got to remember the smartest bankers, iBankers, consultants in the world actually had a liquidity issue, not a solvency issue, even for their own capital calls in 2007 and 8. We haven't lived through that. So the retail public is often promised a product which says 30% guaranteed return, and to the shock of it, they also promise them liquidity. To me, that's going to actually kill the industry, especially given the way SEBI is. So my only caution is to each their own. I think if you want to attract retail money but make sure it's packaged well and the appropriate risks are highlighted, because this is going to come back to haunt the industry after a few years.
Very, very true. Very true. Thank you. Now I'm going to move to a few trends. I think we've talked about India, we've talked about capital raising. Way back in 2010 when I was new to this industry, all the investments that I saw were minority investments. Like private equity funds in India did not really do a buyout. It was rare. And today, if I really reflect all large transactions, they were like $100 million funds, now they're $1 billion investments, right? So we've moved a long way from being just a minority passive investor to a very active investor and manager of the company. Coming to you, Roshni, you've seen several buyouts, and the biggest part of the buyout is not the investment, but what you do with the company after that in value creation. So if you could just elaborate a little bit about what have you seen and done in your portfolio companies on value creation, and then we move to ESG as another trend which we want to talk about. But first, maybe on buyouts, I think I would want panel's views.
No, again, thank you very much, and good morning to everyone. I think you're right, Bhavan, that we've seen a journey between a lot of minority passive to more majority and control and even buyout and platform building, right? So it's been a journey. That said, I mean, and Manish will correct me if I say, majority is the only way to go, to say you can also be a minority investor and get great returns. I think it really depends on the DNA of the firm. What we have seen, at least from an Everstone perspective, is we started off with a lot of minority, but I think fundamentally we were made to actually kind of build businesses. So there was a little bit of conflict in the way we worked with minority-based investing versus majority. Now, most of our investments are controlled, or in some cases, like in our climate impact fund, we've even gone ahead and built our own platforms, which is taking it to the next level. Now, in terms of value creation, that too we've come through a journey, and I believe that we're still on a journey to really be able to truly make the difference between what is committed when we put an IC case to what we actually end up delivering, because what we saw through the years is that there is an IC case, and then year on year, you're actually making your own case. So you're never going back to checking out to see what made you say that at that point in time, what has fundamentally changed. What we did realize is what we did not fundamentally do was to really go through the pieces of what we agreed, or value creation as we call it, and then work very closely without being in the company. You cannot take over the management's job. That's not your objective. But really to look at 3 or 4 big levers that truly make a difference. We have 5 years, the way we look at it, right? In all reality, while we say we will give the fund back in 10 to 12 years with an extension, fundamentally, if you want to make the right returns, at least in majority, you need to be able to turn that around and have it ready for exit or exited in 5 years' time. In those 5 years, there are only 2 or 3 big pieces that you can move that will move the needle. One, clearly, is people. At the end of the day, we all know that all of us sitting here, we are probably the only assets our firms have. Simultaneously, the true assets, and whether it's manufacturing or whatever, it's not plant and machinery. It is actually the people. So one is really to put the right people in place, but also to enable them to understand what they're supposed to deliver. So many times I've seen, as funds, what we end up doing is we bring in a star CEO and then assume that he's going to wave this wand and everything's going to happen in line. And the poor guy has absolutely no support otherwise. So that's one big piece of value creation that now we have started getting into companies, looking at where they are, assessing, and then there's a whole science to it that we actually follow through. So that's one. The second is fundamentally able to support the whole go-to-market or brand transformation, which is another piece that we work on. Because you can't do everything for every company. You have to really take the 2 or 3 things. And that's another piece that we focus. So we've now created what we call as an operating playbook, and we've seen it succeeding. What we've seen is at the time of exit, we're much better prepared. We are able to answer the questions to the future investor, financial or strategic, in terms of what happened, why, and how we went about delivering. We're also able to create an organization that is ready for the next phase of growth. So in terms of, I think, the value we're all able to add in terms, when we actually look at more of a majority control, I would say we're able to control our destiny better.
Moving to good one. Manish, have you seen your teams behave differently when you moved from minority to now majority? What is it that you have seen and built as part of your team? Do you have a separate operating team?
No, so I actually am where Roshni is completely. I think, in my mind, it's not about control or non-control. It's the amount of value you add and how you deploy that value, right? So the levers of value is exactly as Roshni laid out, which was people is a single. And I think, given we mostly support first and second generation entrepreneurs, their access to human capital is not as good as the conglomerates. So having Everstone or a TPG or a Kedara in there makes it a lot more attractive. Makes a huge difference when Pramod Bhasin, one of our operating partners, calls up a potential CEO for a tech company than any of us calling him up, right? It's just that, and that's not just using a name. It's actually Pramod's as involved in it, or probably more involved than I will be in that portfolio company. So that's one. But the only place, and that's what Roshni sort of referred to earlier on, I defer is, for us, we're going to do both control and non-control. And I share a chart, not only with investors, but also with the team, because everyone likes saying that, I'm just, I kill the holy grail. People love calling themselves as control guys. In India, you need to be flexible, is number one, that's what the opportunities are. But secondly, if I do a simple McKinsey, and I was ex-McKinsey, which is why I'm using that term, analysis of x-axis being level of equity ownership, and your y-axis being either returns or a second analysis, which is the amount of time you've spent on the company, you would assume this would be an upward sloping curve, right? So the more equity you have, typically you should have better returns. The more equity you have, you should spend more time against it. I'll tell you, Manyavar, where we had our smallest equity ownership, probably had the largest amount of time that our team put against it on how do you get a CFO hired, a top CFO to go to Calcutta? I mean, Bombay, Delhi, it's easy to hire. Bangalore, maybe. Calcutta, forget it. Nagpur, even worse. So to understand that aspect, so that's a minority situation where not only was the time ridiculously high from an allocator of time, but also the returns were significantly higher. There's a control situation, which is we haven't spent that much time, and I would say the returns aren't as good either. So my only caution when people move towards this fad of going towards control, of saying we only do control, is to keep your eyes open and be flexible enough to do both. I mean, I think some people are probably structured in, buyout or growth, and maybe you want to talk about that.
On buyout and growth, maybe I want to just flip a little. So once we say that we have invested significant, like 80%, 100% of the company, and when it comes to exit, we want to decide whether we want to really go for IPO or whether we want to just have a strategic sale, like a clean exit. How do you really look at that decision making as to whether IPO is the only way out, or you would prefer a clean exit and just not have the headache of the IPO mark-to-market gains and losses, and what has been your journey around that?
Yeah. So I think the exit situation has evolved a lot for the industry over the last decade. When I started doing private equity in India, the holy grail for exit used to be to find a global strategic, right? If you can find a MNC to come and buy you and do a strategic sale, that would be the number one top option. And then maybe you will look at a public market exit, and then another sponsor sale to another private equity. And at the bottom of the ladder was a potential Indian strategic. I think that has completely flipped now. So people don't even care about global strategics. The Indian strategics have become extremely aggressive and are willing to pay up for the right business. Indian public market has become very vibrant, and IPO opportunities are for real. Being able to sell large stakes, large blocks in public market is real now. Just last week, we've seen a couple of $1 billion plus blocks, whether it was ITC, and Blackstone and KKR and us. We've all done large blocks, overnight sales, sales within a week. So Indian market has got depth now. So there are various exit tools available, and buyout funds such as ourselves have used a variety of these. So whether it is public market exits, refinancing through dividend recaps, selling to other sponsors, selling to Indian strategics, selling to global strategics. So I think India has come a long way now. That question is not asked anymore on how will you exit this company, and you can optimize based on where the business is, who the co-shareholders are, and what you see as a long-term future for that company.
Selling to other private equity that you missed, that's also an option.
Absolutely.
One of the things. Like there are lots of P2P deals that we are really looking at happening. Yeah. Moving to Wendy. Wendy, ESG has been one area which all the DFIs and sovereign funds insist that the GPs meet their expectations. And was talking to Roshni like way back in 2012. I think you were one of the LPs, and 2015 were the LPs, and that was one of the conditions under the LPA. So just tell us about the journey as to how have you seen GPs move from just a compliance to like really doing something around ESG, and how is that translated into portfolio companies doing compliance and actually embracing ESG?
Yeah, thank you. So yeah, as a DFI, it is a requirement of our capital. Remember, our capital comes, any DFI, comes from all the citizens of the world in various configurations. So ours is global, of course. And India, by the way, is 6% of our shareholding in IFC. But I think there has been an evolution on this space, and I think on both sides of the table, right? So it is a requirement, but we also have very much, I think, had a good dialogue with all of our investees, whether they be direct or funds, about where this also is a tool of value creation, right? So there is, opportunity, there's market opportunity, there's risk management that comes out of, environmental, social, and governance as well. And so I think it needs to be considered on both sides, right? And one of the things that we've done, and we would be the first to say, and we say it to every new or old client, is that we understand this is probably one of the more challenging parts of what we're requiring as an investor. But we also have, teams that will, work with you, and we're willing to take on the feedback, and we have adjusted our own standards as well to be more relevant to emerging markets. I'd say, for instance, particularly in space like, for instance, corporate governance, I think, if you go back 15 years ago, there was a very kind of set approach to how corporate governance should be done. The fact of emerging markets having so many family-owned businesses, and we realize that that's actually a huge value, that we want to create more value out of that space. So we adapted a lot of the corporate governance guidelines, to consider, family-owned businesses, just as an example. But I really feel that going forward for any fund, whether or not you have DFI capital LPs looking at your fund or not, it's actually a space that is a requirement to be working in our market here in India. We have basically a lot of untapped resources, right? We have low female labor force participation. That by itself could raise India's GDP if there was more women in the labor force. We have cases like major water scarcity in many areas of the country. So this is not. It's not something that's just an added on because your LP is requiring it. I think it really should be embedded into the value creation mechanism for any firm that's looking at the medium to long term.
Okay. Thank you. Just we're short of time, means last question, and then we'll open it up for the participants here to ask questions. But on diversity and inclusion, what is it that, maybe I'll start with Anand, what is it that NIF is doing? And maybe I will want panel to also chime in.
So thanks, Marvin. Great question. So look, let me talk about NIF, and then let me talk about what we think as LPs, right? And I just want to pick up one point that Wendy talked about, ENS and ESG in particular. So before I joined NIF, I used to work for Macquarie. We set up our first fund in India in 2008, and IFC was an anchor investor. For a global manager who, I think we were the largest infrastructure manager in the world, and when we saw the IFC requirements on ENS and ESG, we said, wow, we have never done this before, right? And I think from there for a global manager to not know what you do in emerging markets on ENS, I think that was a steep learning curve for us. Today, I don't think that's where the market is. I think the market has learned. And this is great sort of credit to IFC for implementing that and pushing that down into the businesses that they back. I think the market really knows what you expect on ENS. Now coming to DEI, I think DEI today is where ENS was maybe 15, 20 years ago, right? I think there is a start of a conversation. I think obviously capital sort of talks more about it, and GPs sort of then start lining up. At NIF, just to give a sense, we are at the leadership team, we are about, I think 33 or 35% women. At the team level, we are about 44%, I think, women. So I think we are in a good place, but it's also a challenge to make sure that we maintain those levels, in some cases increase those levels. So 44 may be an average. On the investment teams, it'll probably be lower than across the organization, right? what are we doing? So we are actually very actively working to see what can we change in terms of policies, in terms of practices, in terms of seeking feedback from our women employees. We've actually created a cohort called Ekika, which actually looks at what do we need to do as an organization from a policy point of view. What do we need to do from a flexibility point of view for women when they go through different phases of their life, which often coincides with different phases in your career, right? So we're doing all of that. As an LP, I think we have broadly talked about principles on DEI with our managers. So in the 8 funds that we've backed, we've committed about $600 million to date. I think over the next 5 years, that'll be $1 billion and probably 15 GPs that we'll back, right? And now I think for the next 5 years, what we want to do is, ENS was a big topic, and I think we've sort of raised the bar on it in our portfolio. We want to do that on DEI. So we're actively working to develop a structure where we can work with our GPs, not just to say that, you know what, you need to have X percentage women in your team, and then people are hiring women so that you have a face on a page. I think that's probably the worst outcome, right? We want to make sure that there are women who are hired at junior levels, who can be retained, who will grow in their careers, who are supported well. So all of those things are things we're thinking about, and we're going to put together a structure where we can work with our GPs, handhold them if necessary, bring in external experts to sort of coach women, to coach in some cases men to have the right mindset, right? So all of those things are things we're thinking about when we think of deploying over the next 5 years.
Sorry, no, brilliant. Anyone else? Roshni, want to just?
Yeah, no, I think Anand covered quite a bit. And I was just going to say that DEI is still coming up the curve. And I think a lot of what is going to happen will be very dependent on how capital pushes GP. I've always said that, and I always maintain it. Equivalent to IVCA, we have something called SVCA, which is the Singapore Venture Capital Association, and I co-chair the DEI committee there. And we did a primary research in the local Singapore fund ecosystem. What came through was not surprising at all, that there are 44 to 45% women who join in. So junior level, firms are becoming more aware. They're bringing them on board. However, as you go up, and we really laddered it out to check, right at the top, there were less than 20%. Women in investing or operating roles were around 15 to 17%. At the senior level, and women were just dropping off. And the reason is because while firms are beginning to think about DEI, there isn't enough that's being put in place to retain those women. So that's one. On the portfolio side, however, I think a few of us have had success, also because we are almost like an LP into a portfolio company, right? So, for example, in ours, we actually, coming back to what he said, don't just allow for numbers to be put. It's very easy, right? You say 50%, you'll get a bunch of women I put in everywhere, and there's 50%. But really to see what are they doing, what levels are they, is there a woman on the board? Because what we've also seen is that if there is a woman definitely on the board, and more than one, because India has mandated one, so suddenly women are in big demand to become board directors, just to kind of put a name on the face. But that's not the point. If there is more than one, they're able to influence and take it all the way down. So there are things happening, but I would say it in sum that what we have seen is that the LPs have to start kind of pushing through, asking for more data. And I think in the next 5 to 7 years, we will see a massive transformation happening.
Super. Maybe Mitesh, you want to just go, and then we'll open it up for questions.
Yeah, so diversity, equity, and inclusion is as essential to our business performance as it is to our culture and values of our firm. We are deeply committed to the cause to be part of this long-term social change. There are various ways in which we are addressing this, so we want to be a voice and influence towards this. Internally, the number one thing, as in everything else, what gets measured gets done. So the first thing we have done is, over many years, establish metrics that we track regularly. We hold ourselves accountable and transparently report diversity metrics, whether it's in recruiting, promotions, etc., to the entire firm. And that keeps all of us on our toes and accountable. We have a DEI council that's partner-led. 18 partners from across the globe represent us on this DEI council. It's chaired by our CEO and our COO. This council also reviews all compensation decisions, promotion decisions to make sure there is equity. We have broadened the funnel in hiring to bring in diverse candidates. We have created engagement, retention programs, mentorship programs to make sure there is progression for the right set of candidates. There's a bunch of stuff we are doing. This council also has created many affiliate groups which regularly hold talks and networking events for various DEI groups, whichever people want to affiliate with. That's all on the internal side. We also actively engage with our ecosystem. So on the portfolio company side, over the last 7 years, I think we would have added some 400 board members from our diversity profile to our portfolio companies. We constantly and very vocally speak out on DEI issues in the industry. A culmination of all of this recently was a new fund that we launched, which is called TPG Next. This is a fund which is has been launched to support underrepresented alternate asset managers. Started with an anchor commitment of $500 million from CalPERS, and we are building around that anchor commitment, and it's one of its kind fund, industry leading, but speaks to the passion and the commitment that we have towards this initiative.
Thank you so much. Thank you, everyone. We just have one, actually the time is up, so we just have one question from the audience, and here, as I said, that you should be able to get all the answers with this panel, which is so diverse. So anybody, any questions?
Given that there are so many avenues of capital for the, the corporates or the entrepreneurs itself, given public markets is also becoming more and more mature, you have the pre-IPO funds as well bridging the, the gap. How has the priorities changed over the past 15, 20 years that you have seen in your experience as a fund of your size to now delve onto what are the value add that you can bring when you're going and putting your name across with the the portfolio company that you want to partner with. So just wanted to understand, are you seeing any changes, any priority trends are emerging from that perspective? Just wanted to hear your thoughts there.
Sorry, who is this to?
Probably more to maybe Manish and maybe Mitesh, you as well, given you bring the global perspective also. So what are you seeing now grounds up as India is also maturing and the fund accessibility has been solved for to quite some extent. It's not there fully, but some point has been answered already. So just from that perspective.
Thanks for that question. So definitely the sources of capital and financing have expanded for corporates in India. And that is a good part of a vibrant public market, right? The public market becomes a source of financing. It becomes also a source of wealth creation for individual investors. But the solutions are very different that a public market offers versus what a private market offers. And globally, if you see the trend of where LP allocation is going, if that was your question, and these move very slowly, very gradually, right? Because we are talking about tens of trillions of dollars over here. But we are seeing slow shift from public market towards the private market. And the reason for that is the value creation that can be done in the private market. So a company which is not mature enough to be listed and be measured on their performance every quarter might not have the right set of systems, processes, people that Roshni and Manish spoke about, organization build out. All of these things is where a private equity fund comes in, which can help these companies to get to a stage where they can get listed and access public market funds. Because going public is one part, but living a life after being a public company is a second part of the story, right? And it's very hard if you're not prepared as an organization to be a public company. So we have invested in more than 36 companies in India now over the last 2 decades. Most recent one was a consumer electrical company called RR Kabel. It was a 100% family-owned business. The reason they brought us in, and we had a 21% stake there, was to help them professionalize the business and make them public ready. So they were at a scale where they could have gone public, but they were not at a maturity level where they could have gone public. So that's the difference, and we're seeing that evolution where entrepreneurs and owners of businesses are increasingly realizing the value of what private equity firms bring to the table and how they can use us beyond just being a source of capital provider.
So just a few things to quickly add to what he said. One, three things specifically. One, the only reason a guy will come to you versus the public markets, and by the way, we regard the public markets as our biggest competitor because all companies have a chance, excuse me, just move a little bit. All companies have a chance to approach the public markets if and when they're ready, and as he said, that's often the choice they need to make. Second, you need to remember private equity is the most expensive form of capital funding. It's much cheaper to go raise debt, and it's probably cheaper to go to the equity markets because the rate of return you expect is 18 to 20%. Private equity is 25 to 30%. So unless you can convince the promoter that you can add value, and no promoter or entrepreneur is any less smarter than any private equity person, I can tell you that. It has to be a marriage which is mutually beneficial, right? So they'll only come to you, which is why there will be many companies which should not go to private equity. They should go to public markets, or they should lever themselves further. The only ones, and we would also say, I would say the only thing which has changed in us is it's word of mouth and the reputation that you've developed. One, are you easy to work with? Do you add value? Do you help the companies if, as you said, they want to go an IPO? Whether it's by adding on a professional team, a CXO suite, whether it's preparing the company to IPO, what is the degree? So while we are still beating the pavements every day to look at new companies, it is our previous investments and word of mouth from them that has caused new entrepreneurs to come approach us, knowing we are, and we underline this, are the most expensive source of capital.
This is brilliant, actually. I learned a lot in this panel. Thank you so much. It was very, very interesting and enriching conversation. I think with this, we close the session. Thank you again, all of you.
Thank you.
Thank you so much to each of our panelists. I request you to stay back because Wimpy would like to present you with a token of our appreciation. I would like to invite Nithya Iyaswaran, Managing Director, Multiples Alternate Asset Management. Please do the honors, ladies and gentlemen. A round of applause, please, for Nithya. Thank you, Mr. Shah, for moderating this panel so beautifully. Big thank you to Ms. Werner for joining us as well and sharing your insights. Thank you, Mr. Unikrishnan. Ladies and gentlemen, keep that applause going for our distinguished panelists. Thank you to Ms. Bakshi and Mr. Manish Kejriwal, as well as Mr. Mitesh Daga, for sharing your insights with us. And a big thank you to Nithya Iyaswaran for presenting the token. Thank you so much.